Hey guys, we're here for our next session, which is around. So one of you guys has Crowdcast open, which is why there's an echo. So has the second Crowdcast window open because you're watching the previous session. So just please close that, and the echo should disappear. But anyways, we're here for our next session, which is macro predictions for 2021 and beyond. And I'll let the speakers introduce themselves.
I guess I'll jump in and kick it off. Hi, my name is Dan Elitzer. I'm co-founder of Nascent, which is a global multi-strategy crypto investing firm. We do a lot of early stage stuff, particularly in DeFi, but we're also very active in liquid markets, particularly with a lot of on-chain borrow, lend, and trading activities.
I don't know where that's coming from.
Sounds like you, Stephen. Do you have another tab open?
Yeah, I found that I had an extra one open that I didn't realize. So while you were on that, I'll introduce myself. I'm Ari Pine, co-founder of Digital Gamma. We have a digital asset repo market, and I've been involved in trading in various ways, from debt markets to options markets and futures markets as well. So that's my background, and looking forward to hearing from everybody else. Thanks for having me on.
Yeah, my name is Stephen McClurg. I'm the co-founder of Basket and Valkyrie. Basket is a new stable coin coming to market. So more news on that very, very soon. And Valkyrie is another asset manager focused on bringing products to market, like the Bitcoin ETF that was filed about 2 months ago. My background is in mostly traditional finance, trading macro and managing macro funds, fixed income, and all the various derivatives around fixed income. And can't wait to get started here.
Well, cool. What did you want to start out with, Steve? I think you had a little bit of a plan.
Yeah. Well, Ari, you actually brought up Janet Yellen and the Treasury General Account. You want to share some of your thoughts on what you think might happen when the Treasury starts flooding the market with maybe $500 billion?
Yeah, pretty soon it's real money, right? So for those that may not know, the Treasury General Account is the account at the Fed that the U.S. Treasury uses. So long as that money is sitting, or that there's the large balance of money that's sitting at the Federal Reserve, it's not actually making its way through the system. So the Treasury, and what Janet Yellen has announced, is that there's going to be a drawdown of that. Drawdown meaning they're going to take it from the Federal Reserve, they're going to move it into, general population, right? So now it's going to start hitting bank balance sheets. And as you know, when you start handing people money, they want to put it to use. They don't want it to just sit there. So the question is, where's that money going to go? I think overall, there's a feeling that it's going to, on balance, be dollar negative, right? More dollars in circulation, making it less valuable as people bid up various assets. So some of the things that we've seen unwind over the past, 2 weeks or so, Treasury yields have backed up pretty substantially. And even interest rates, there's an anticipation of tightening coming up. So shorter dated interest rates have backed up a bit. And so the question is this going to impact the markets, stocks, or bonds, and shorter term rates? There's actually a prediction out there that Treasury bill yields are going to go negative because people are going to try to find any port in a storm.
Yeah, I mean, I don't know much. I'm just an old bond trader, but I tend to think that backup in rates is going to be short lived. People are getting excited that rates are starting to go up again. Think about it as Bitcoin going from 58 to 47 and consolidating in that range, and then shooting right back up to 250,000. That's what the bond market's doing right now, and it's going up. The rates are going up, which means bonds are going down. It's consolidating right here, and there's a lot of things, in my opinion, a lot of macro things that are happening that will push treasuries to negative. I'm betting that it goes negative. So if you're buying a house, wait a couple of months to get your mortgage. It'll be much cheaper. And if you don't know, people that don't know, mortgages are based on the 10-year. So even though it's a 30-year mortgage, but yeah, wait a little bit, and we're probably going to see negative rates again. I think we get into the 60 to 80 basis point range here in short order, and in the next 18 months, negative rates.
You think negative rates on the front end, or even going out the curve?
I don't know if we're going to see it in the 10 and 30s quite yet, but on the front end, the belly, I think we're going to see it in very short order. And by the way, we're already there in Europe. The trade has always been when German boons or gilts go negative, then people in Europe start putting their money to work in treasuries because you're yielding something, unless there's a belief that inflation is going to happen in the U.S., which, in my opinion, we're going to start seeing inflation in other countries as well, and further money printing in several other countries. I don't think the U.S. is necessarily isolated here.
So how is that going to work? What is the relation between what happens in the U.S. with interest rates and inflation, and what happens in other countries?
So generally, what happens is there's two things to factor. The dollar can become weaker, meaning more money is put into the system. And if you look at the central banks in other countries, they're not following suit as fast as the dollar is at the moment. So if you look at the Bank of Japan, or the People's Bank of China, or some other central banks, they're not printing as fast as the U.S. is. But Japan and China are both major export countries. And in order for exports to be competitive in those countries to the same goods in the U.S., you have to print money. Otherwise, the goods in the U.S. cost less in international markets, and that can hurt the manufacturing sector in these other countries. And so the U.S. is sort of forcing, or is, in my opinion, going to force other countries into that state of money printing as well.
Well, I think there's also some other facts as well, right? Because we've looked at globalization over the past 20, 30 years, or longer, actually. And so a lot of the inflation, inflation can be a very polarizing topic, right? Because people come out and they talk about, well, the price of a car hasn't moved very much. The prices of TVs have come down, and so on. But what has happened overall is that global goods, or really goods, things that you can ship from one country to another, have stayed very low in price because there's a lot of supply out there, right? Countries that have a capability of producing at a lower price point because of their cost of living are able to export those items. Local stuff, such as health insurance, homes, services, can't move. Education can't move from one nation to another, right? That's far more difficult. And because of that, it's those items that have had sustained inflation. And so the question, to bring it back to where we were talking before about the Treasury General account, is, what sort of policies are being implemented, right? So there hasn't been much overall index inflation as it's calculated. as a monetary phenomenon, right? Because what happens is you push this money out, and in theory it's hitting everybody on average, but in truth, if you are buying assets and you're creating a monetary phenomenon, what you're doing is you're helping rich people, and because by definition rich people have assets. Not because anyone's trying to do anything probably specifically, but that's just the way that the propagation mechanism works. So if that changes, and if there is a policy out of Treasury that instead there's going to be fiscal policy, and we're going to build roads or buy things, or somehow help people out in various ways where we're just sending cash out, right? So what happened last year, you saw people spend it. So if I give money to somebody that has an insufficient amount of disposable income, right? They can't pay their, they're barely making rent. They're going to spend that money right away. Now, where we are in the world today is a very supply-driven economy overall, because there's lots of supply. We don't need that, right? That's what monetary policy helps, right? That would be trickle-down economics, and that helps when you need more supply, right? You've got a lot of demand, but you're having trouble putting in place the capital equipment. That's not our problem. Our problem is there's an insufficient demand, so nobody wants to buy this capital equipment. So that would be, for me, what I would look for in terms of a trigger for what people would think of as sort of, overall broad-based inflation.
Yeah. So I'm going to read one of the comments because it's very relevant to what you just said. It looks like Cameron Shorg says we'd need labor and other markets to inflate as well, not just financial markets. It's one of the reasons we aren't seeing inflation in the true sense, which is true.
Right.
Wages are stagnant at this time of increased inflation. And when wages are stagnant, people that are dependent on wages for money and assets, like you said, Ari, they're not getting any more money. They might get a cute stimulus check in the mail, but that doesn't really help anybody, unless you're just you need the money, right? And but if the more assets you hold, which the wealthier you are, the more assets you hold, and at some point there's a tipping scale where you have more assets than income, and anybody that has more assets to rely upon than income are the ones that are going to do much better in this environment. The wealthier you are, the more assets you have than income.
Right.
All the way up to the point to where you're a CEO making $1 a year in salary and earning billions of dollars from increased, money printing from the Fed. So yeah, that's absolutely right. And you can't, and it's difficult for too much inflation to kick in without that wage growth, but it can still happen, right? That happened in the 70s, and that's not a great situation. So we'll see how that plays out. But talking about assets, asset growth usually comes, or asset, value growth comes with inflation. It's why there's all these like interesting little instruments in the market, like tips. Everybody thinks that tips are a great inflation hedge. They're not. It's absolute worst inflation hedge you could get. But the name is, it implies that it's inflation protection because it's in the name. So equities have historically been a better inflation hedge than almost anything else in the liquid markets. But what other assets do you guys think are going to do well in this type of environment?
I mean, I look at this, I'm like, how can Bitcoin not, right? This feels like the environment that Bitcoin was explicitly made for. And as somebody who came to Bitcoin and got interested in this space from a technology perspective, much more so than any kind of view on monetary policy and government control over it. It still feels like the perfect setup. And I think we're seeing more and more big name investors and companies, start to realize that. I think, retail investors are realizing it too. The narrative is just built over time. And, it's hard to imagine an environment, looking back when I started paying attention to Bitcoin better part of a decade ago, trying to like conjure up as ideal of a situation for Bitcoin to grow in. Like this is just pretty amazing.
Yeah, I mean, and in relation to that, I think we'll come right back to Bitcoin, but like NFTs are really hot right now too, right? Some of them I think are kind of weird. Some of them I think are interesting, but other things that do well in an inflationary environment are things like fine art and wine and bourbon. I've seen I saw one group launch a bourbon fund. I almost invested in it because I like bourbon. But all these things that you previously couldn't put into an ETF, right? You can now put into an NFT, and I think those are very interesting inflation plays as well.
And I think everybody would benefit from one of the things that we spoke about before when we were prepping, and you were talking about the difference between the rally now.
Yeah, the 2017 versus now. Yeah. Well, I mean, so actually, when you mentioned NFTs, that's the current piece of the market that feels most 2017 like to me. And I think kind of like tokens themselves, I think there's a lot of ridiculous stuff happening in 2017, but there was a kernel of something very meaningful there. And I feel like there's that with NFTs now. Not that there might not be a lot more room to run, but I think we're of anything, I am like most certain that we will overshoot with NFTs at some point and it'll come back. But what we were talking about before was 2017 was about ICOs, right? That was what drew a lot of new people into the space. Quick ICOs, flip them quick. There weren't really stable coins at the time, and so all these projects were raising primarily in ETH, and that was what people had to come in through ETH, and then lots of ETH were being held in the treasury of these companies, or in some cases, early versions of DAOs, and it just pumped ETH, and everything was just kind of spiraling upwards. But it was all white paper based, and so there was not really very much actual thing there, right? Some of the projects did come out, and Aave and Synthetics were both from that era, and have really pushed hard and built something meaningful. This time feels different, right? This is a Bitcoin-led rally rather than an ICO-led rally. And as we were just saying, this feels like an incredibly favorable macro condition for Bitcoin. At the same time, in the private markets and public markets, you look at assets, it's hard to get to like a reasonable valuation on some of these things. I'm a big believer in DeFi. I think there's a lot of real use happening there, but I don't think anyone's doing deep analysis. But DeFi is real, and there's real use happening, and so there's something worth dragging up along with Bitcoin. And so when I look at the price of private rounds, I look at the price of assets on any kind of like reasonable valuation methodology based on like even astronomical growth rates. Like it's hard to justify some of the valuations we're seeing on some of these projects. But if Bitcoin keeps running, it's hard to believe that other things don't run with it. And so, will we see a correction at some point? Sure. But it's hard for me to believe that we're anywhere near the end of this run just based on macro conditions.
Yeah, I agree. I mean, we're making big bets in Bitcoin in particular, and then a couple of other assets that we think will come up along with it. But I mean, we even hold Bitcoin on our own corporate balance sheet. I mean, why wouldn't you? The way that I see it is, every economy has its own currency, has its own central bank controlling it, has physical borders. Some economies don't. Ecuador, so as an example, Cuba has poor currency, which is why they use dollars. But outside of those examples, I truly believe that Bitcoin is starting to become the currency of the digital economy. And that's why you're seeing tech companies put it on their balance sheet and start transacting in it. and I think others are going to follow. You know, if you've ever paid anybody overseas, you know how big of a problem it is. Just getting money into people's accounts. Now you can do that, and we live in a truly, you know, we're starting to become more and more of a borderless economy in a truly digital economy. And as that grows, I think Bitcoin's going to grow. I think we see 500,000 in the next 18 months.
Yeah, wouldn't surprise me at all.
Okay, so I'll take the bait. So if I personally am bullish too, just because, which scares the crap out of me. But I'm kind of bullish too, just because I think that we are seeing institutions coming into this market and they are very slow motion, right? I can decide, you know, as a fund or whatever, that I'd like to participate in Bitcoin, but it's going to take time to change my documentation. It's going to take time to file with regulators and so on and so forth. And so, you know, a decision that's going to be starting to be put in motion now is going to take time, right? So there's going to be, in my mind, an ongoing floor underneath Bitcoin. The question is, you know, if I'm looking at this, right, my natural tendency is to say, boy, we've moved so much, right? I mean, you know, we've just even from at the end of last year, right? I mean, look at the move that it's made. I mean, you guys don't see any sort of consolidation or that move down to whatever it was, like 37,000 was it, and get back on.
Well, I mean, we'll see more consolidation happen at various points on the way up, right? That's in 2017, there were 7 or 8 drawdowns in like the 20 to 30% range. And I think that's just kind of the nature of the beast. You know, it's still not a super efficient market. We still see weird things happening on, you know, exchanges that are a big part of the market. So, you know, things can happen. There can be bumps along the way, but I think we tend to think of things in crypto, like just everything moves so fast. And this is not like the next new protocol launching and like, you know, people doing forks of new things. This is Bitcoin. It's been here for over a decade. People are finally like starting to catch on in a big way. And as you said, it's like this ship that just takes a while to steer and to get going. But once it does, like, it's not slowing down. It's not stopping. It's taking a little while to get out of the gate.
Yeah, very interesting. So in this case, right, you've got the opposite of what's sort of going on one of our other potential topics, which is the sort of the ETF grantor trusts going out there, right, where there's where they can issue more and more shares. You just can't do that in Bitcoin, right? So you're stuck. If you want to participate, you know, you just have to keep, you know, forcing your way into the subway train, right?
Yeah.
Until it gets bigger.
Yeah, that's exactly right.
I'm curious to kind of tie it back, though. You know, one of the things that has been amazing to me as you know, someone who's been following Bitcoin for a long time, has been the growth of DeFi and the ability to now earn on Bitcoin, and to use it, you know, as effectively productive asset for any range of strategies that you want to pursue. How does that tie into how do the interest rates that we're starting to see emerge for both centralized crypto lenders and these decentralized protocols play into the trends that we discussed earlier with interest rates just getting pushed down globally in traditional markets?
Well, with any asset, you get rates based on the value of the asset, and if the value of the asset, let's say cash, right? If the value of the asset is in continual decline, and is expected to be less valuable, then you're going to earn a lower rate. If you have an asset that is expected to have a higher value, and it can't, and no more can be created, then it will have a higher rate. But I think, Ari is really the expert in Bitcoin lending. That's what he does.
Yeah, I think it's super interesting, right? Because right now you've got a situation where, unlike what we talked about in terms of inflation, and there's a very global market, the crypto market itself is very locked out of the banking industry right now. And I think there's a talk later when you're going to talk with the guy from Tether, where that's obviously a very central part to their story in terms of their ability to find banking relationships. And because of that, people have tremendous demand for US dollars and presumably other fiat, but I see it mostly in the US dollar side. And whether that is collateralized or otherwise. And so as that opens up, the interest rate market is gonna, I think, find a tighter equilibrium than, where on one side you've got, 40 basis points on the good end if you're doing some like 3-month repo or something like that. I mean, you're talking about like A2, P2 commercial paper, and 3-month is, tens of basis points, but you can earn, 700, 800, 900 basis points, lending dollars and receiving Bitcoin collateral, or even higher. I mean, it's a fluctuating rate, but you're talking about like double junk bond yields.
Yeah. Well, what's interesting is all these banks don't want to have a consumer or commercial banking relationship with you if you have the word crypto or blockchain or Bitcoin in your name. But
so
you'll file
they're wrapping up right now,
and see
as
how
I'll
many
give
of
you
those same banks call you
warning
wanting
before I
to
put people in.
I think we're getting the hook. Yeah.
Awesome. This was fantastic. We're going to transition to our next session now. Thanks so much for your time.
Thank you all.
Yeah, thanks for having us.